You know how compound interest works. You've read the articles, watched the videos, and bookmarked the strategies. Yet here you are, sitting on the sidelines with exactly $0 invested, completely frozen while the market moves past you. The most common reason you haven't started is a number in your head. You probably think you need to save up $1,000, or maybe $10,000, before you are officially allowed to become an investor. That minimum threshold is a ghost. It is an outdated hangover from a financial era that doesn't exist anymore. Decades ago, if you wanted to buy a stock, you had to pay hefty commissions and buy full shares. If you only had $50, the fees alone would wipe out your entire investment before it even began. The system was intentionally gated. You had to go through expensive financial professionals and manual trading desks just to participate in the market. Those physical and financial barriers collapsed years ago with the rise of modern brokerage apps, yet people still point to those invisible walls as an excuse to delay. If you are waiting until you have a perfect lump sum or the perfect market conditions, you are caught in a loop of procrastination disguised as preparation. You are waiting for a moment that will never arrive. Let's look at the actual math of that delay. Say you decide to hold off for 5 years so you can save up a neat $3,000 starting fund. This chart compares two trajectories over 30 years. One investor starts today with $50 monthly. The other waits 5 years to invest a lump sum. Look at the gap. Waiting costs up to $30,000 in lost returns. Returns are strictly percentages. A 4% return operates the exact same mechanical way on a $50 balance as it does on a $50,000 balance. The math doesn't care about the size of the principal. Enough money does not mean hitting an arbitrary savings goal. It means having an amount, even just $50, that you can consistently contribute, starting today. Two modern innovations make this small-scale strategy possible: zero-commission trading and fractional shares. A fractional share is exactly what it sounds like, a piece of a single stock that you can buy for a specific dollar amount, rather than paying the full share price. This means you can cut your $50 into precise slices, owning pieces of highly profitable companies without needing hundreds for a whole share. This enables the core engine of the entire strategy, the dividend snowball, powered by a mechanism called DRIP, or a dividend reinvestment plan. DRIP is a brokerage setting that automatically takes any cash a company pays you and uses it to buy more stock. Step 1. Your share pays a cash dividend quarterly. Step 2. DRIP automatically reinvests that cash to buy a larger fraction of that stock. Step 3. The cycle repeats. Your larger share pays a bigger dividend, buying more stock. The loop accelerates. Generating passive income does not require day trading or staring at screens. It requires setting up a mechanical loop that executes quietly in the background without daily involvement. To build a reliable snowball, you have to ignore volatile tech startups and speculative trends. You only need 2 to 3 established, large-cap companies with decades of proven profitability. Building this system takes exactly 90 days. In month 1, you establish your auto-investing rule. In month 2, you receive and reinvest your first dividend. By month 3, the habit is entirely locked in. The only real threat to this process is picking the wrong companies. If a business cuts its dividend payout, the compounding engine stalls and your snowball melts. Avoiding those traps requires a specific set of rules. You have to run every potential stock through a strict 4-filter checklist to weed out bad companies and identify the ones that will keep paying you for decades. The true goal of these first 3 months is to shift your identity. You permanently transition from a paralyzed observer into an active, systemized investor. If you stick to this automated system, simply contributing $50 a month, the math projects a portfolio worth over $60,000 in 30 years. Years from now, you will be one of 2 people. Person 1 will look back and wish they had started today, so they could be collecting thousands in dividends. Person 2 actually starts today and reaps that exact reward. The only difference between a future with $0 and a future with passive income is the physical decision to start right now. Stop researching and start executing. Pick up a copy of the $50 Dividend Investor by K.R. Talon. Inside, you get the complete 90-day execution blueprint, the essential 4-filter stock-picking checklist to keep your money safe, and access to free bonus tracking sheets to monitor your progress. The permission you have been waiting for is right here. Grab the book at the link in the description and start building your dividend snowball today.